couple key things you want to look at. And one of them is obviously cash flow. You want to make sure that you're going to have a positive cash flow. But the real reason people buy rental property is for the long-term appreciation. And what I'm about to show you, a tool that most loan officers don't know how to use and never even share with their clients. It's an internal rate of return. Let me show you how this form works. You're going to love this as a tool to analyze potential rental property purchases. So what you do is this. Last week's Todd Talks, I did this example of John and Ray homebuyer buying a rental property for $350,000. So we plug in the present value. We plug in the $350,000. In this case, we use the 25% down. We use the down payment, the closing costs excluding taxes and insurance, for a total out of pocket of about $95,000. Then we said, let's look at it over a 60-month term with 4% appreciation. That puts the property value at about $425,000, 6 years out. If you were to sell the property at 3% cost of sale, which is $12,000 and some change, the mortgage balance would be $244,000 that someone else has paid. You're going to have a net proceeds of $168,000. So that's your net gain on your capital investment. And if you look, you see the periodic payments here. You're assuming a rent of $2,500. In this case, we've got a nice, we've got a positive cash flow after our expenses. We put a little bit of a vacancy loss just to cover for vacancies here and there in between tenants. And then what we did is we plugged in the rest of the numbers, and we came up with this formula. It's the internal rate of return formula. So the present value is 95, the future value is 168. That represents an 11.8% return on your investment. And that is what you need to be looking at. So what I do with my clients, when we first develop a mortgage plan, we look at their entire situation, everything, assets, insurance, estate plan, current mortgages. We develop a acquisition strategy for the real estate. And then once we have that strategy based on their available assets and what they can qualify for, then we execute the strategy. And as they find properties, we plug them into a total cost analysis to show the net worth. And we plug it into an internal rate of return to make sure that over a period of time, we're getting a return on the investment. And what really wealthy people do, they'll keep these properties, and instead of they actually never sell them, or they try to never sell them. If they do sell them, they do what's called a 1031 exchange, where they sell the property and they use the money to buy an additional property, and therefore there's no capital gains tax event. And then as they develop equity, if they need to tap the equity rather than selling it to avoid capital gains, we do cash out refinances to grab the equity out. And as long as the property is still cash flowing, you've mined that equity, you still have an appreciating asset, and yet you've had no capital gains tax event because you haven't sold anything. So those are the kind of things you can do. That's the internal rate of return. Join me in next week's Todd Talks. I'm going to begin to talk about some house hacking strategies so you can buy a house, live in it, and turn it into a rental property. Is a great way to build a rental property portfolio.